Welcome back to Market on Close. We got 10 minutes into the bell here. Stocks about where we left them going into the break. Let's talk big picture themes with Michelle Gibley and Cooper Howard joining me from the Schwab Squad. Cooper is Director of Fixed Income Strategist and Michelle is Director of International Research. We're kind of ending the conversation today as we began it with Jeff Kleintop and MTL. Michelle talking about international stocks outperforming. Pretty important fact so far this year, right?
Yeah, in fact, international stocks are up today and outperforming this year, despite the drumbeat of America First policies. And, if we look at growth in Europe, it's expected to accelerate this year. Germany is leading a potential shift towards stimulus. The CDU and SPD parties in Germany are looking to maybe quickly approve as much as 200 billion euros in defense spending, maybe as soon as March 24th. And then in terms of the stocks, they're benefiting from low expectations and underperforming heading into this year. And investors might be allocating away from being overweight in the US and away from tech stocks. And, Europe in particular has a big weight in financials, which are outperforming this year and not directly exposed to tariffs.
That to me does kind of argue in favor of the explanation of stock selling being more attached to valuation, rotation, and other themes rather than some kind of cataclysmic, realization about the economy or tech or something, because those valuation spreads have pretty much just been waiting for a reason to close, it seems like, right, Michelle?
Yeah, that's right. We've got the EMU index, that's the European Monetary Union, the Eurozone. It's trading at under 15 times next 12 months earnings. It's a 32% discount to the S&P 500, which is very buoyant at 22 times. So, yeah, it's all about the valuation and expectations going into this year.
Okay. In terms of the message being sent by bonds, Cooper, I guess the credit markets would argue no reason to panic either. I know that there's been some widening of spreads, but they were quite tight, and the widening isn't too huge, is it?
I don't think so, Oliver. I would agree with you in your assessment of kind of where the credit markets are looking. It's really been a story over the past year, not just recently, of how tight spreads are. And I think some of that's being driven by a part demand side of things. The other part is that the outlook for the economy has continued to hold up. Obviously, we're going to get tomorrow's GDP figure. It is expected to be relatively okay. So we're expecting about a 2.3% increase there. So if you look at kind of the other major drivers of the economy, the consumers tends to be holding up all right. Labor markets tends to be doing all right. I think really what the big question mark in terms of where the economy is headed is a lot of the policies coming out of Washington right now, Oliver.
Tell me, Cooper, what you think moves the needle most, I guess, for treasuries right now, because obviously there's a lot of effort to cut all these federal employees and try and trim fat, purported, and make it a leaner machine. So if anyone thought that bonds had softened up these last few years due to like fiscal concerns or deficit concerns, is there any counterpoint to that now?
I think where the Treasury market especially has been caught between kind of over the past few days is what's the outlook for great growth and what's the outlook for inflation. I think today what we're seeing is a little bit of concerns on the growth front. We saw the consumer confidence number come in pretty weak, and that's really what shot yields down significantly lower on the day. I think if we look out on the near-term horizon on the inflation front, obviously we're going to get Friday's PCE report. I think that that's going to be a pretty big one for the market, Oliver. If we see it surprise to the upside, it wouldn't be too big of a surprise to see yields move up from here. However, in our view, where the 10-year Treasury has been trading right now, it does appear as though it is relatively fair valued. So one simple metric that we like to look at is what is it looking like? Where is it relative to the Fed funds rate? On average, that's about 100, 125 basis points, but there's a fairly wide dispersion of it. So really what that suggests, Oliver, is where we're at right now is probably fair valued, but it really depends as far as a number of different factors that are going to come out. And I think that that has the impetus to push it higher or yield in terms of yields.
Okay.
Higher or lower in terms of yields, excuse me.
Yeah. Well, Cooper, to that point, we've got a busy second half of the week here. We'll get GDP update, jobless claims. We'll get inflation on Friday. The two-year yield backed off pretty quickly here when stocks sold off the past week. So was the market maybe thinking that like we would get zero cuts possibly have to hike or something this year, and then a little risk off just takes that right off the table?
I think that the hike narrative, I know it has kind of trickled out there, and it's great to talk
maybe
about
a
it on
serious
shows
one.
like this, but I would agree with that. I don't think that it's really a serious one. I think that the bar to hike is very high. So our expectations in terms of what the Fed's going to do is we still believe that they're on the path to cut interest rates, but it is data dependent. I mean, that's the biggest thing that we're looking at right now. If the economy continues to hold up okay, and we do see a downturn in inflation, then yes, we would expect probably one more 25 basis point rate cut this year, maybe two. I say maybe a little weak there. But our view is that yes, the Fed is going to continue to cut interest rates, but again, it's dependent upon how the data comes in. And going back to the near-term outlook on it, I think that's where the PCE figure on Friday is going to be an important one.
Okay. Michelle, last thought on the subject for the rest of the world. Is there as much interest rate volatility, or is it more kind of a clear-cut path for everyone minus the BOJ?
Yeah, the Bank of Japan is an interesting one. In fact, the yen has been strong, and economic data in Japan has been strong as well, paving the way for another hike. I would note that the 2-year yield on JGBs, Japanese government bonds, is up nearly 20 basis points this year, versus the U.S. 2-year yield is down 15 basis points. So the differential between the two is narrowing. And that's what's been making the yen more attractive. But speculators are not short the yen like they were back during the yen carry trade concerns.
All right, so maybe not as big of a tender pile as there once was. Dollar's been pretty soft, so it doesn't seem like the market's been too volatile around that subject for now. Appreciate it, guys. Thanks for the thoughts, Michelle Gibley, Cooper Howard.